Hey, what's going on, everybody? It is Trevino here, and we have a wonderful guest. We have David from Washington, D.C. How you doing, David?
Hey, pretty good, Aaron. Thanks for having me on.
Yeah, absolutely. It's great to see you. I know we'd spoken before and had this in the works, and it's great that we finally sat down and doing this talk.
Yeah, no, I've been looking forward to it, so I'm glad the day's here.
Yeah, absolutely, David. Well, for those of us who aren't too familiar with you, would you introduce yourself?
Sure. Yeah. So I'm a direct DUS lender. I am based out of the DC office, but we do business all over the country. And I have done deals in many states around the country in all regions. I primarily would consider myself a consultant, kind of a part of investors' teams as they're putting together good deals and trying to make their investors money and give tenants high quality housing.
Okay, absolutely. I'm always fascinated, even by the word consulting or consultant. When you say consulting, what are you, what are you specifically doing?
Yeah, I mean, I really am a lender. I say consultant in the sense that, I really try to partner with my clients on what their goals are to achieve on whatever deal they're working on and how it fits in with their business plan on the deal or their business plan or their strategy in the market or their long-term goals with their business. So I kind of try to tailor the loan solutions to whatever fits that uh, whatever their goals are the best.
Okay, solid. Yeah, absolutely, David. So are you originally from the DC area, or did you recently move there, or?
No, yeah. No, I've only been down here about 2 years. It's a good jumping off point to markets like Texas and Florida, where I do a lot of business. And I previously was up in Boston, so spent about 8 years in Boston and was looking for a change and figured why not shorten my commute when I'm going to meet clients and go to conferences and look at real estate.
Yeah, that makes a lot of sense. So you're originally from Boston. You grew up there, or?
I actually grew up in Maine, so yeah, no, I did not grow up in Boston, but I spent like I said 8 years there. Grew up in a small town in northern Maine, and then never went back after college.
Fair enough. I don't know much about Maine. I hear the summers are beautiful, though.
Yeah, vacation land.
Yeah,
So they
absolutely.
call it.
Yeah, no, I'm just curious. At least in Maine, when you were growing up, did you always know that you wanted to get into real estate or this space, or how did you get into this sort of role?
Yeah, I had no idea. Actually, it's perplexing because real estate is actually quite a large industry, but even all the way through college and a few years after until I finally did get into real estate, I had never even thought of real estate beyond uh, you know single family sales agents that are selling homes to folks. I didn't even consider that it was an industry or that there was uh, you know jobs to be had or money to be made in the industry until I had been working in banking at a couple large banks for a few years and realized I wasn't really feeling what I was doing and wanted to change. And so I started kind of networking myself into kind of investment consulting roles and ultimately found real estate through kind of interviewing with some of those companies and looking at what they're focusing on. And once I found real estate, I was kind of hooked on the business model and hooked on the opportunity in the industry.
Yeah, absolutely, David. I'm fascinated by that as well. Is it, a lot of people have this, maybe, I guess, a misconception of, real estate is, strictly buying and selling homes. Was there any particular moment that you kind of, had an interest in other parts of real estate? Was there anything that happened in particular?
So when I first got started, I got started on the debt side, but I wasn't planning on staying on the debt side. I actually I thought that I wanted to get onto the buy side and be an investor, which I am, but primarily my day job is on the debt side. And what happened is I got in and I realized I was good at it. And I started progressing quickly through my career. And one thing led to another. And I realized I'm really adding value to people with what I'm doing, and I'm good at it. And, I became a resource that people go to. So it kind of became this thing where now I have no reason to put it down, and make a big change all at once, just because I'm enjoying the people I'm working with, and I get a lot of face time with my clients and that sort of thing.
Yeah, absolutely. It's great that, you kind of had that start in banking, and you're still kind of using that financial acumen to where you are now.
Yeah. Yeah. I mean, that's really all it is. I mean, the numbers in real estate are actually some of the simplest numbers in finance, to be honest. So maybe that's why I'm good at it. But yeah, no, definitely. I mean, using my background working in economics and in business and finance. I mean, real estate. That's all we're doing here in commercial real estate is basically financing businesses. They're in the business of providing housing, which is what I do. I don't do a whole lot of retail or office.
Okay, yeah, understood. So when you were, so you were banking in Boston before, right?
Yeah, I worked at State Street Global Markets in foreign exchange group, and I worked at J.P. Morgan in their hedge funds group for a short period of time as well. So that's kind of those are the two jobs that I had leading into my quest for real estate, or to find real estate, and yeah, never looked back.
Okay, fair enough. So I left Boston, been in DC for around 2 years, right?
Right.
Okay, so when you showed up in DC, that was your, I guess, your first real estate related job.
No, no, no. I moved down here. I took a new job in real estate that had an office down here, and I had been looking to potentially relocate somewhere else just to get some new scenery and meet some new people and be in a different part of the country for a while. And so I moved down here with a job, and then I left that job shortly thereafter as well.
Yeah, yeah, absolutely. So I know you said that you live in DC, you're all over the country in terms of where you're doing deals. Do you do deals in DC or kind of within driving distance or not so much?
Yeah, yeah. I mean, I've kind of been a city guy for many years now, so I don't do a whole lot of driving myself. But yeah, I mean, I'm doing a few deals in DC at the moment, and I also have deals in Florida, Texas, Oklahoma, Kansas City, Missouri, and other areas. Memphis, Tennessee. Well, I'm looking at quite a few deals in quite a few different places, but I do business in the area, so I'm familiar with it.
Okay, yeah, absolutely. So I know you kind of touched on it earlier. You talked about how you were in commercial real estate. You worked on the debt side. Maybe on a day-to-day basis. Could you kind of elaborate more on what you're looking at or what you're evaluating for deals?
Sure. Yeah. So I would say probably half of every day is spent on the phone. And that's a part of the job that can wear you out, but it can also be the funnest part of the job. Um, Sometimes it's nice to just get some time to jump into an Excel model and crank out some numbers or some music. But the for me the fulfillment comes from talking with my clients and helping them figure out how to get the best deal that they can. And so I would say half of my time is on the phone, and within that time, I would say half of it is probably working on existing deals, and half of it is probably helping clients figure out whether they have a deal, whether it's financeable, what they need to think about, what they might be able to offer. Um, you know, other considerations from a lending perspective that they might not be aware of. So all of that kind of goes into about half of my day, and the other half of my day is kind of coordinating with internal parties on existing business that's in the pipeline, setting up, models and applications for new deals that we're trying to bring in, and then just kind of working with the computer and the systems and getting everything where it needs to be to provide the smooth experience that hopefully all the clients are getting.
Yeah, yeah, absolutely. So kind of when you're evaluating your deal, or even when you're on the phone, do most of your clients have a property under contract, or they currently own it, or kind of, when you first have that initial call with them, what are they looking for?
Yeah, that's a great question, Aaron. The it varies. I mean, I have some clients that are very, very experienced. I usually don't hear from them until they've got a deal almost locked up, and they're just looking to, push the dollars a little bit more, or they're looking to make sure they're on the right side of the line when it comes to their kind of interest rate that they're projecting out, things like that. And then there's kind of the opposite end of the spectrum, or the clients that are, don't quite have their feet on solid ground yet. They're, putting in the work, and they're, studying up, and they're meeting with brokers and getting deals to look at and sizing things up, but they just don't, they don't yet have 100% confidence in what they're seeing. And so as a professional in the industry that, that would, potentially bring 80% of the financing for their deal, they come to me and ask me what I think, and how I can help, and what loan structure I would recommend, and any out of the box scenarios that they need to be aware of relative to the market or the collateral, or anything else.
Yeah, absolutely. I'm sure part of, I guess, your homework or your due diligence would be, verifying the value. At least in single family, you would kind of look at comps. Do you also have comps in commercial real estate, or how do you determine the value?
Yeah, absolutely. Yeah. I mean, we rely a lot on comps. There are two main approaches to valuation in commercial real estate. It's the sales comp approach that you're referring to, where we look at comparable properties, see where they traded, generally on a kind of a per unit basis, because how else do you compare apples to apples, and when every property has a different number of units? So we generally use per unit with the sales comp, and we make sure that if our value that we're hoping for is 50,000 a door, we want to make sure that 50,000 a door is not in a market where all of the comps have traded from 30 to 40,000 a door, just to make sure that we're supported, that sort of thing. The primary method of valuation in commercial real estate, though, is the income approach, because again, it's important to remember that versus residential real estate, kind of a single family, and even duplexes, when the owner is going to live in the property, those are done generally by banks, and oftentimes, they get residential mortgages that are kind of based on personal income. Ours, we're lending on businesses, right? So our borrower is going to come in generally with a limited liability company as the ownership entity, and they're going to operate the property as a business for profit. And so the income approach basically takes the income, subtracts the expenses, and then applies a market level cap rate to the net operating income to determine what the valuation would be. And the cap rate is a complex number that gets applied kind of, again, by using comps, by using market data, and also factoring in certain things like, unrealized projected tax increases, unrealized potential upside based on capital improvements. Those sort of things will also get incorporated into a cap rate. So, it's not every property getting the same cap rate in a market, but that's the primary method for determining the value, is based on kind of what the owner can be expected to achieve, or the buyer can be expected to achieve when it comes to income, and kind of what the risk of that they're taking for that income.
Yeah, absolutely. A term that you mentioned a few times was cap rate. Could you kind of expand more on what cap rate is and why it's important?
Yeah, it's a complex term, and I always encourage people not to get too hung up on cap rate, because at the end of the day, that's not the be all end all. And I've certainly had people reach out to me over the years and say, what cap rate should I be buying at? And it doesn't quite work like that. But just a quick example, it's sort of a measure of of risk. And the example would be, you're going to see lower cap rates in New York than you will in Tennessee or Ohio or Oklahoma. So basically, the capitalization rate just tells you, if you have a lower capitalization rate on the same, say, $100,000 of NOI, the lower cap rate is going to be a higher price deal. So, in Manhattan, your cap rate might be, 4%, meaning that you basically don't have a whole ton of risk because your property is in, one of the largest cities in the world, and you're always going to have tenants, or you're always going to have businesses or demand for the product that you're offering, which is in our case housing. Whereas in suburban Oklahoma, you might see a cap rate of 8%, where there are a lot of suburban properties for people to choose from. The tenant bases could potentially be significantly lower income and have higher delinquency and more skips and move outs and higher vacancy, and all those things contribute to less secure cash flow. So you're gonna end up oftentimes seeing higher cap rates in those markets. So if you're buying a deal, you obviously want to buy it at technically a higher cap rate than your seller is going to want you to buy it at. But it's not the be all end all. I mean, if you can go in and double the rents, then buying at a low cap rate is acceptable, because you're gonna end up increasing the NOI, and your cap rate's going to effectively get cut in half. So it's not the be all end all, but it's just a measure to test the reasonableness and the risk of the cash flow that you're looking to pick up when you buy a business.
Yeah, absolutely. I can see how that can be a tough decision, because on one hand, you could buy that property in Manhattan at a 4% cap because, people are coming in, or you could buy, something for 8 or 10%, but yet it's, I guess, seemingly unstable, right?
Right. I mean, another way to look at it is kind of in consumer debt. Some people that have high credit scores might get a credit card at 10% interest rate, or 10% APR, or 12 or whatever. And then some people that have really poor credit scores might be able to get a credit card, but their rate is going to be 27% or 30% or something like that. And you essentially assume that the rate's higher, but if you do enough of those, you extend enough credit at a higher rate to people with low credit scores, some of them are going to default. So you're not actually going to make you 30% across the portfolio of low credit score individuals. So it's basically higher risk, but when they do pay, it's higher reward. Same thing in real estate. Properties that are in more suburban markets with more competing properties, lower income tenant bases that sometimes run out of money, or pay 2, 3, 4 weeks late all the time. It's just higher risk. There's a chance if they don't pay, there's a chance they skip out and disappear from the property and you never get paid. But when they do pay, you're at a higher cap rate. If everyone pays, you're probably going to make some good money. Whereas in New York, everyone might pay, but the property valuation that you had to pay to buy it is so high that there you go. You're not making too much more than that 4%.
Yeah, absolutely. Maybe more so about the types of deals you do. I know earlier you talked about evaluating something at, $30K or $40K a door. It sounds like, are you mostly working with multifamily? Are you kind of working within a certain unit count or?
Yeah, all multifamily. Um, the definition of commercial multifamily generally starts at 5 units or more. So you can think, a 5 unit building in New York, or a 20 unit building in Miami, or a 100 unit building in Texas. That's kind of what we're working on. The other guideline that we have is generally we can't do loans below $1 million. We can in certain instances, but they are more challenging to get done, and there's a tighter box, and certainly the interest rate is a little higher for the borrower, and so there are a number of headwinds there, but they can be done. But generally, anything over 5 units and over $1 million is fair game.
Yeah, absolutely. I mean, those are huge markets, whether it's, Texas or Florida or New York. It seems like there's kind of a global, or maybe not global, but at least a nationwide shift, to needing more multifamily.
Yeah, yeah, certainly there is. I mean, I think that's one thing that you see when you look at the data is that people project the multifamily industry to continue being strong just because there's so much demand for housing, and um, builders just can't keep up, or they're not keeping up. They're doing what they can, but there's always a need for housing, and I think I think particularly in the space that I spend a lot of time in is kind of workforce housing, lower income housing, not not city-based projects or anything like that, but just housing for working class folks all around the country, which is kind of the largest demographic, right? So those people need quality housing. Doesn't need to be fancy. It needs to be safe. Needs to be secure. Needs to be family oriented. In a lot of places, in a lot of ways. And then obviously there's difference between over the years. I mean, a property that was built in the 70s is going to have very different amenities and a very different style and construction quality than something built in the 90s or the 40s or whatever. So I mean, there's certainly there are different aspects to what we do when we're looking at deals when it comes to collateral, but there's always a need for more affordable housing.
Yeah, absolutely, David. So a big question I get, at least in the lending space, is, what makes a good deal? So, maybe something comes across your desk, you're, kind of running the numbers, you're doing your homework on it. What makes a stellar deal that you would fund?
Yeah, it's that's a tough question. I think we work through issues all the time. I mean, every deal's got its own issue, its own personality, so to speak. And I would say that the best deals are the deals that have solid cash flow, um, consistent rent collections that are, the property might be 94% occupied or better, with consistent collections that are not kind of super up and down every single month. 1 month at 50,000, the next month at 40. We'd rather see something at 49,000 every single month than these major swings. Um, Same thing with expenses. We'd like to see expenses that are more consistent rather than seeing, giant $5,000-$10,000 expenses in 1 month and then nothing for the next 4 months. So those things certainly make deals a little cleaner. But the cash flow is really key. Again, we size all these loans, making sure that they meet their cash flow requirements, which for us in most markets is a 125 debt service coverage, which is just a ratio of the NOI over the annual debt service. So we want to make sure that if the debt service per year is, the principal and interest annually is $100,000, we want to make sure the property is producing an NOI of at least 125,000 to service that debt. So we're not cutting it too close so that one bad month and the borrower can't pay their mortgage, that sort of thing.
Yeah, absolutely. That makes a lot of sense. So you touched a bit about, the cap rate, the NOI, kind of making sure that your bases are covered with those ratios. Is there anything else you kind of look at as well when evaluating a deal?
Yeah. I guess the additional things to think about are, when you think of the deal as a whole, we're lending to a business. Businesses involve people, so we look at the the borrowers. So the borrower team. So it could be two partners that each own 50-50, or it could be four partners that each own 5%, and then they're bringing on a bunch of non-active limited partners. We really just look at what the borrower setup is, but we dig into what the sponsors on the loan, who's signing the loan docs. We want to know whether they have experience managing properties, how many properties they own, where they are, how successful they are in terms of, are they underperforming? Are they distressed, or are they performing well in generating income? We look at their credit scores. We want to make sure that they have sufficient financials. And generally, our guideline there is a net worth of 100% of the loan amount or more. So if you're doing a $5 million loan, we'd like to see whoever the borrower is and their multiple partners who are joining them on the loan. We'd like to see that they can have a net worth of at least 100% of the loan amount. And then we also look at, from a management perspective, making sure that the property is going to be operated properly. We like to see, again, that sponsors have, owned properties before, multifamily properties, not just any property. We like it if they have experience in the market. And we also really like third-party management, unless obviously the sponsor has a large company, it has thousands of units they've managed before, but otherwise, it's always beneficial to have, a reputable property management company in the market that might own, 500 to a few thousand doors that they manage, and they, can get, preferred pricing on products. They have staff that can cover if someone's sick. They have software that can help, keep the accounting straight at the property, those sort of things. They often have software that helps them, lease units more quickly and, take work orders and get things, brought back online more quickly. So third party management is also another big pillar of our financing. But it's basically, the numbers, so the financials of the deal, the sponsorship, the management, and the collateral. So obviously, we're not lending on properties that have, giant holes in the roof or asteroid sized holes in the parking lot. We're trying to lend on properties that that are habitable and that is safe and comfortable for the tenants.
Yeah, absolutely. So, maybe something that was distressed, or I mean, even worst case scenario was, maybe condemned by the city or something. You would never touch a deal like that.
That's not a deal that we would take on. No, we're primarily in the permanent financing business with Fannie Mae and Freddie Mac. So, they like stabilized properties, and so that's what we finance. Something that's completely condemned or completely distressed, call it sub 60% occupancy, is going to be a better fit for maybe a local bank if they'll do it. Might even be a little bit too much for them. So then you're looking at kind of private money, bridge money, hard money, whatever term you're used to. So those sorts of financing sources are generally higher interest, just because they inherently carry more risk if the borrower doesn't execute their business plan of renovation and releasing the property, that sort of thing. But we would not generally out of the gate touch a property that is condemned and 0% occupied. But oftentimes our borrowers are experienced professionals that buy properties like that, renovate them, lease them up, and then they come to us, and we're always happy to help out on a refinance when someone's kind of turned around a property and helped turn around a neighborhood.
Yeah, no, that makes a lot of sense. So a few terms you used earlier, maybe if we're not familiar, would you describe, what's Fannie Mae and Freddie Mac?
Yeah, yes, that's a good one. So Fannie Mae and Freddie Mac are both government agencies, government-sponsored agencies. GSEs is what you might hear them called. They're both governed by the FHFA, which is the governing body in the federal government that basically dictates how they operate. And they each have their own. They're similar, but not the same. But they each have their own set of guidelines as to what properties we can finance, what minimum requirements those properties have, and then how we underwrite those properties with respect to income and expenses. And again, they dictate, a 125 debt service coverage, and they dictate, 100% of the loan amount for net worth for small balance loans, and they'll dictate, certain markets are less favorable for them, and so they'll have them as pre-review markets or kind of lower tier markets where maybe the pricing's higher, or maybe they need to review the deal before it gets approved or something like that. So, but essentially they're the guarantors, guaranteeing the note, the security. All these loans that we write are basically get sold, traded on the secondary markets. So we continue to service the loan, but we don't hold all of the debt. The loan might be bought by Bank of America or Citibank or Goldman or what have you. So those investors, we call them, those note investors, buy our notes because they know how they're underwritten. They know they're underwritten to the same standards every time, with very little kind of room, very little margin for error on how they're underwritten. So that's kind of the process where Fannie Mae and Freddie Mac are basically kind of almost guaranteeing the way the loan is underwritten, and the credentials of the borrower that we're lending to.
Yeah, absolutely. So just curious as well, kind of that note buyer, right? That's wanting to, to buy those notes that have been underwritten properly. What do you think they're looking at in terms of a good note to buy?
Yeah, you're testing the limits of my experience. I've actually never worked at a shop that's been in the note buying business. But what I can say is that they use all the same metrics that you or I would use if we're going out to buy a property. They prefer deals in better markets. They prefer deals that are, better collateral, maybe an 80s property instead of a 1940s property. They prefer deals that aren't in hazard zones. I mean, it's all the same stuff. But at the end of the day, again, we have to underwrite all loans to the same standards, and those standards are what these note buyers know. They know the standards, and so they know that when we underwrite a loan and we get ready to market it and trade it, that they know basically what they're getting, and so they probably dial in a little bit more just on, okay, what rate of interest am I going to get if I buy this note? And so these are bonds basically. So that's what they're buying. And the bond market, there's a premium for not a premium, but there's the stability of the notes that we're selling because of the way they're underwritten, because they're, Fannie Mae, Freddie Mac kind of backed securities, mortgage-backed securities. Then they have pretty secure cash flow, because we run a lot of credit checks and we, do the underwriting the way we're supposed to. And There's a lot that goes into making sure that we're doing good loans, and the default rate of Fannie and Freddie loans is actually quite low. And so it's basically secure cash flow that they're using for whatever their bank's purposes, have allocated, towards those type of securities.
Yeah, absolutely, David. Just curious as well, another word that you used earlier a few times was collateral. What does collateral mean in this context?
Yeah, so the collateral, I mean, think about if, you go up to somebody in a pawn shop and they want you to give them collateral or something, right? So they might give you $500 to go buy something on the street, but you're going to have to leave your license or your credit card or some other information so that they can track you down if you run off with their stuff or whatever, right? They do the same thing if you're test driving a car. Before they let you take it off the lot or something, they're going to collect some information from you so they can come after you if you don't bring it back. So for us, the collateral is the property. Our loans are all non-recourse loans, meaning our recourse to what we can go after if the loan defaults for non-payment, say, is the property. We don't actually have the ability to go after individuals signing on the note and taking the money unless they commit what we call the bad boy acts. So that would be, like fraud, mortgage fraud. That would get you in trouble with us, and your loan could become recourse. But being a non-recourse loan, we want to make sure the collateral, which is the property itself, the bricks, the boards, the roof, the land, we want to make sure all of that is good. So title is important, making sure we have clean title. We get engineering reports. We want to make sure that the structure is sound and safe for people. And then we get oftentimes, depending on the size of the loan, but oftentimes we get some level of environmental screen or environmental report that fills us in as to any environmental risk. Because if you're not familiar, environmental risk can be very expensive if federal or state agency comes in and says, "Hey, your land is contaminated. You can't have people living on your property because they might get sick." And so all of a sudden, you need to dig up your property, even if you didn't cause the contamination in the ground or something like that. So environmental concerns are big, and so we get environmental reports. So all that plays into the collateral, and the collateral and the way that I use it is basically the property that we're lending on.
Sure, David. Yeah, that makes a lot of sense. So you've kind of talked a bit about, being in Maine, being in Boston, coming down to DC, kind of what you do right now. What are you looking to build on into the future? What are you looking to do, in the future in this industry?
Yeah, a great question. I'm in my early 30s, so I got plenty of life left in me in this industry, I think. But for the foreseeable future, I'm still focused on debt solutions and building my client base. I have a lot of great clients that are sending me referrals seemingly on a daily basis, so that certainly makes me feel good and speaks I think volumes about what experience my clients have had with me. So I'm just looking to continue to deliver high quality service and soundly structured loans to my clients. Always looking for new clients, new relationships. For me, that's the biggest part of what I enjoy about my job is meeting new people and spending time and effort on deals with the clients that I've built relationships with. So that's kind of the near term. I like to invest in real estate as well. So I am always open to investing, particularly with my clients in their deals, and kind of growing that partnership that way. I do own a couple of smaller properties myself that I just handle myself. But just more of that, more investing, more lending, more relationships. It's really kind of what it comes down to for me in the industry, I think.
Yeah, makes a lot of sense, David. Well, is there anything else you haven't said that you'd really just like to hit home?
No, there's nothing kind of that I'm itching to get out there. I certainly appreciate you having me on. This is great. I think your listeners are going to get a lot of value out of this and all your other shows as well. So I would just encourage your listeners to keep doing what they're doing. I think they're probably getting exposed to a wide variety of participants in the industry, and certainly anyone that wants to can feel free to reach out to me. I'm always happy to chat with people and build those relationships. So my email is David.Frasz at Lument.com. Our company is Lument Capital, formerly Hunt Real Estate Capital, if any of your listeners are familiar with it. So anybody can get to me that way. I'm happy to set up a chat.
Okay, yeah, sounds great, David. It's been a real pleasure having you on the show, talking a bit more about your background, a bit about the banking, the financial terms, the real estate, multifamily, and it's been great having you. So thanks for coming on the show.
Yeah, my pleasure. Appreciate you having me.
All right, we'll talk to you soon, David.
All right, take care.